Good morning, everyone. My name is Michael Naidrich, and I am the co-CEO of Amerivet Securities. And as usual, I am very honored to be joined by my partner, head of rates, all things Fed and liquidity, CFA Gregory Faranello. Good morning, Greg.
Morning, Michael.
So I think we've outdone ourselves this morning, Greg, as we sit here and we enter our end of our third year doing this, which is hard to believe. We have a very special guest. We're joined by the head of rate strategy, global head of rate strategy at TD Bank, Priya. Priya, thank you so much for joining us this morning.
Thanks for having me.
Right, so I'm smart enough now at this point in my career to hand it over to the experts. So, Greg, enjoy your conversation with Priya, and I'll maybe ask you a question at the end or two. Thanks, guys.
Thank you, Michael. Priya, it's great. It's great to have you. We've been doing this now for 3 years. The last year, we've had some fantastic guests to join us, and we're really thrilled to close out our 2021 with you. Traditionally, we like to dive right into it if it's okay with you. So, to start, I'd like to get your thoughts short term, within 6 weeks, a very clear pivot from the Fed here. We've got a meeting this week. All eyes will be on the Fed. What are your thoughts heading into this week's meeting?
Sure, it's a pretty important meeting. I think the market's been setting up for an announcement of a faster taper. So we're looking for the Fed to announce a doubling of the pace of taper from 15 billion a month to 30 billion a month. And what that means is that they would end QE by mid-March. So this is much sooner than just a month ago when they announced tapering. We had been expecting, or the market in general had been expecting the Fed to end QE by June of next year. And we think, the fact that the data has been coming in really strong. We're forecasting 6% GDP in the fourth quarter. Inflation numbers have come in much higher, and they've just lasted longer. These high prints have lasted longer than what the Fed forecasted, as well as what private economists had forecasted. And so I think in order to get policy flexibility, in order to show inflation vigilance, we think the Fed wants to end QE. And that allows them, therefore, to hike sooner than what they had been expecting or than what the market had priced in, if need be. I'm going to stress on that if need be aspect. In terms of, you talked about the really short term. As I said, the market's been setting up for this. So I think announcing the doubling of that pace, I think it's priced in. The front end is pricing in the first Fed rate hike in May of next year, 3 hikes in the first year. I would say that's all very consistent with if QE does end in March, can they turn around and hike in April or May? And the market's largely priced for that. Where I think we're not fully priced for is the long end. Because remember, the Fed through QE, there's just not a signaling aspect of not hiking. The Fed is also buying 80 billion of treasuries a month. And that's going to go to zero by the middle of March. Meanwhile, the US Treasury continues to have to fund a large deficit. Now, the deficit next year we think is lower than this year. So this year we were about 3 trillion and we're expecting 1.3 trillion deficit next year, so much lower. But in terms of duration that the market will have to take down, that's still fairly large. And so I think what is not fully priced in is the fact that the Fed has been a big buyer of duration. They're going to step away, and rates will need to move higher, in our view, to attract buyers of other assets to come into treasuries. And so I don't know if this is the next 6 weeks, or does it take a few months of auctions, sloppy auctions, or set up into auctions for the market to price in that actually tapering means higher long end rates as well. It just doesn't mean the Fed might hike sooner. It also means that we need help to take down all these auctions. And so we're looking for higher 10-year rates. I think over the next few months, getting close to that 2% level is what we're forecasting, and triggered to some extent by a faster taper.
Sure. No, it is certainly interesting. I think a couple of things in the marketplace, and maybe we could talk a little bit more about that sort of medium term outlook. If you look at what the market is saying, they're certainly construing, I think, this quicker taper to mean quicker rate hikes, right? When you see the pricing march through June and certainly 2022. So, I'm curious, what are your thoughts? And obviously, we've seen the dramatic flattening of the yield curve. I mean, what are your thoughts with regard to the faster taper and how that construes with regard to potential rate increases in the medium term in 2022?
Great question. I mean, the Fed will continue to try and separate these two as two separate policies, different conditions to meet, and more stringent conditions. Chair Powell's addressed that many times, that they need to get a lot more done before liftoff. But I think the market's always viewed the two as being linked. And to be fair, the Fed wants to accelerate tapers so that they can hike earlier if needed. So even the Fed is sort of linking the two. So I think it's very hard to divorce the two, the end of taper and first hike. And that's why the market's been pricing in this sooner hike. And so, into Wednesday, into the Fed meeting, if the dot plot suggests three hikes next year, or even a lot of Fed officials looking for three hikes next year, if they do talk about ending QE by March, I think it's very hard for that front end to price in later hikes. So that's the market reaction into the end of taper sooner. Whether they actually turn around and hike or not, and that's where we're out of consensus. We think the economy is going to start to slow in the first half of next year, both inflation and growth. Growth more from a fiscal drag point of view, because a lot of that COVID stimulus has run out. It was very front loaded into 2020 and 21. So you get the fiscal drag next year on growth. And then supply chain issues at some point resolve next year. And we think that's going to bring inflation lower. And so, we don't think the test for liftoff will be actually met until 2023, but the market will just, will need to see that in the data as opposed to anything the Fed can communicate, because literally once they're done with QE, they can turn around and hike. So there's a market link, but then there's a trade there, because if you do believe that the economy is going to slow, I don't think the Fed's going to feel that pressure to hike if the economy is slowing. And we haven't even talked about Omicron. Does that slow down mobility or confidence or consumer spending? That's sort of a wild card, a negative tail risk out there. But even without that, we think there'll be enough slowing that will allow the Fed to be patient, and therefore we're only looking for that first hike in 23. But it's going to need data, I think, more than the Fed communication to push that timing further out.
Sure, no, that certainly makes sense. I think we're probably likely to hear some of that from Chair Powell on Wednesday, this notion of being data dependent as we head into 2022, and they do move away from that taper. But you and I have seen this historically over time, how quickly the market, although they want to try and separate the taper from actual liftoff, how quickly the market encroaches on that train of thought. I'd love to potentially shift gears here, if you don't mind. I know you've been an integral part of the Libor SOFR transition, certainly heading forward to the end of now December 2021. No more Libor for banks. I was hoping maybe you could talk briefly about that transition and what you see and what it means as we head into 2022.
Sure. Thanks for asking about it. It's a very key deadline. I think it's somewhat not as understood by everyone that even though the Fed supervisory guidance applies to banks, it really applies to everyone that trades with banks as well. And so this no new Libor is a very serious guidance, which is, I think, what it's going to do is it's going to really hinder Libor liquidity, Libor volumes across cash and derivative markets. So it's going to force people who have perhaps not traded as much in SOFR to have to take on SOFR as the benchmark of choice. So I think we have to deal with the same sort of two-headed monster that we've been dealing with for the last few years. Make sure that your Libor products have the right fallback. And the House recently passed the federal legislation for Libor. So I think that's a very positive undertaking for what we're calling tough legacy. All derivatives, as long as you're signed up to the ISDA protocol or it's in the cleared world, I think the fallback problem hopefully will just keep getting smaller and is hopefully resolved. And then we really have to move to the new world, the BAU, the business as usual, which needs to now move to SOFR. And I've been really happy with the pickup in volumes in derivatives with SOFR. The SOFR First initiative has been really successful, and expect that to continue to build on SOFR liquidity in linear swaps, non-linear, exchange traded, cross-currency now. And so I think the derivative market can continue to build, and then we'll really be watching the loan market. That's the one I think that's been a bit slow to the uptake and is a bit fragmented with different indices. Over the course of next year, with no new Libor, I think the loan market will be forced to have to pick whether it's term SOFR or some sort of a SOFR average. And that, I think, then creates this nice virtuous cycle where the cash market will create the economic need to hedge SOFR. And so it just won't be, I need SOFR because I was using Libor, but I need SOFR because I've got SOFR on the other side of my balance sheet. So in the next year and a half, as we head towards the end of Libor, I think you'll see that SOFR cash as well as derivative volumes will pick up. But yeah, the end of this year is a pretty key deadline for that.
I appreciate that. It's certainly been a long process, and the evolution continues here as we head into 2022. The Fed ending their purchases, like you said earlier. It seems like we're going to have more pockets of volatility, potentially similar to what we had in 2021. So no, I really appreciate your thoughts there, Priya. Mike, I'm gonna pass it back to you. I think we covered Priya and I covered a lot of ground here heading into Wednesday.
Fantastic, fascinating to listen to, and I always get to get a great education, and super grateful. Maybe as we head up towards our time limit here, just asking about the yield curve and maybe if it will ever steepen again.
Priya?
It is the trillion-dollar question here. I will say into a Fed hiking cycle, typically the curve flattens. The move doesn't surprise me as much. The level really surprises me. We're at the flattest point this far out. Even if you think the Fed's hiking in May of next year, which is priced in, we're extremely flat. My view is that it's a function of where long end yields are, because we've seen significant demand for duration. I don't buy the policy mistake narrative. There's a view out there that the first few Fed rate hikes is all the Fed can get done because the economy is that sensitive to rates. No, I think the economy is actually much healthier, and the Fed will start hiking when they think the economy can handle it. The fact that the curve is this flat is because there's a lot of demand for duration from banks that have been getting these excess reserves. Pensions have been extending out in duration. We think there's some China intervention in here as well. But some of these flows, particularly the bank flow, I think is going to slow down next year. So I actually think this could be the odd cycle where we need not flatten into the hiking cycle. I actually think over the course of next year, we've got a bit of a steepening bias where that front end looks more anchored because the first hike remains 6 months out. The long end then starts to sell off, especially with the end of QE and all the duration that the market has to take down.
I agree. I agree completely with everything you just said. I mean, this policy mistake narrative to me is a bit of a false one, right? Because people don't pile into long end duration because they think the Fed is going to make a policy mistake. I mean, we've certainly seen a good deal of flow at any time 10-year yields get to, call it 170, in and around that range. Long bonds a little above 2%. And the other thing too, as you pointed out, these spot curves are extremely flat. I like to look at 5s, 10s because I think it keeps you away from some of the structural buying in 30 years. And if you look back to 2018, we're at 20 basis points with the actual funds rate close to neutral back then. That curve was at 10, right? So yeah, I agree with you. The curve is certainly looking, starting to look even flatter by the day here. So thank you for that.
Yeah, so I think we're up a little bit against time. First of all, Priya, thank you so much for being so generous with your time as a firm, and on behalf of Greg and I, we are so appreciative. And we wish you and your family continued safety and a joyous holiday season, and obviously with all our clients also, and a happy new year, I guess, Greg, as we will enter 2022, and God willing, you and I will be back doing this with guests that are fantastic. So thank you all and have a wonderful day.